All right, so just rush through the second half of that August one towards the end there. So I might just talk through that quickly again. So on the same day, goods to the value of 369 were sold on credit. So 369 sold on credit. 369 then is going into debtors there. So I've already added a €600 on. So you see there's the 369 is being added into debtors because that's how much he's going to have to pay you. Okay, this includes 23% VAT. Okay, so when you sell stuff including VAT, you collect the VAT and pay it over to the government. Okay, so that 369 is after you have added 23% on. So that €369 is 123%. So you divide it by 123 and multiply by 23, and that's the VAT element of the sale, and that is €69. So of the 369 sale, 69 you are collecting and paying over to the revenue commissioners in VAT. The €300 then is like for you. Okay, that's the money that you would get to keep from the sale. They add then another little kind of wrinkle to this one is that it includes a markup on cost of 20%. So that €300 that you would have added VAT to, okay, that has already had a markup added to it. Okay, so you might think that €300 sale, that's coming out of my stock. I take €300 out of stock, but you don't value stock at its selling price. You should only value stock at its cost price. Okay, so that €300 is after 20% kind of markup or profit has been added on. So you need to go 300 divided by 120 multiplied by 100. That's €250, and that's the cost price of what you sold. So it's that 250 that comes out of stock. And then the difference between the 250 cost price and the 300 selling price before VAT, that's your profit. So that €50 is going in to your profit and loss. Okay, so again, like if you wanted to do 2 columns for August, if you've got quite a kind of long one like that, you can. Okay, because I can nearly end up doing 2 transactions in one there. There was kind of 2 halves to that, but it was long enough. All right, on to September then, and I received €50,000 from the issue of the remaining shares. So in this question, I had 560 shares issued at the start. You might remember from February, I issued 200,000 shares to the people that I bought the business from. So that's 760,000 shares issued now. So I'm saying I'm issuing the remainder now. So that's 760 out of 800. So I have another 40,000 shares to issue. Okay, so you issue 40,000 €1 shares. So you're adding 40,000 onto share capital. What does the question say though? It says that I received €50,000. Okay, so that means there must have been a share premium. Okay, and 50 take away 40, the share premium must have been 10,000. So I got 10,000 more than the shares were worth, and that's a share premium. Okay, I actually received that money, so that's going into my bank account. So reduce your overdraft by 50,000. So that's assets sum to zero, liabilities sum to zero. That's September balanced. October then. So goods previously sold for 738 by Delaney were returned. This figure includes VAT at 23% and a markup on cost of 20%. Delaney issued a credit note for 700 due to a delay in returning those goods. All right, so there's a few bits going on here. So goods previously sold for 738, and that's 123%. So let's figure out the VAT element of that. So let's divide it by 123 and multiply by 23, and we'll be putting that in the VAT account. So the 738 divided by 123 and multiply by 23. So that is the VAT. Plus there instead of multiply. Yeah, so there is my VAT element. So that's just figuring out, so should that be added or taken away? So when you sold those goods, you were collecting money for the revenue commissioners, you were going to pay it over to them, so you were increasing your liability. This is those goods being returned. So you're going to undo increasing the liability. So you're going to decrease the liability. So you're going to take that 138 away. So when you originally sold stuff, it would have been like August's entry here. You would have added on to the VAT liability. But now, because those goods are being returned, the opposite's going to happen. Okay, so you're going to reclaim the VAT. Now, what else is going on? So there's a markup of 20% there. So let's put those goods back into stock. Okay, so when I sold them, I would have reduced stock. I'm getting them back into my stock again. So that's going to be at cost. So we sold them for 738. The VAT was 138. So that means 600 euro is the actual selling price of the goods, but that includes 20% markup. So what I'm going to do is I'm going to go up to stock, and I'm going to go 600 divided by 120 multiplied by 100. Okay, so that's 500 euro worth of stuff going back into my stock. I issue a credit note of 700 euro because there was a delay in receiving the goods. Okay, so I am going to, where are my debtors then? Yeah, so I'm going to reduce debtors by 700 euro. Okay, so credit note is going to reduce your debtors, and I'm saying the credit note is only 700 euro. Okay, so there is a difference here. All right, the difference here would be basically undoing your profit. Okay, so it should be the difference between the 500 and the 600 that you're putting into profit, but you're not giving them a credit note for the full amount because there was a delay in returning them. So what I'm going to put into my profit and loss is just a balancing amount. So I'm going to be minus 62. All right, so like that debtor there, that should have been minus 738. Okay, so normally you would give a credit note for the full amount. All right, but I only did minus 700. So because of that, instead of undoing the full 100 euro profit, I'm undoing 62 euro of that because I'm hanging on to 38 euro of the profit because of the delay in getting the stuff back from them. Okay, so under normal circumstances, you would expect this number here to be minus 738 and this number here to be minus 100. The 100 being the difference between the 5 and the 600 euro, the cost price and the selling price. But there's the 38 difference because of the delay. November then, so we've got a creditor owed 4,000 by Delaney. They accepted equipment in full settlement of a debt, and it gives us the cost and the book value of the equipment. So creditor of 4,000 euro accepts this equipment in full settlement of the debt. So that creditor of 4,000 euro is gone. So let's take 4,000 euro away from creditors. I'm getting rid of equipment that cost 5,400 euro. I'm giving that to someone, so I don't have it anymore. So I'm going to take 5,400 away from the equipment cost. it tells me that the book value was 3,200. So if it cost 5,400, let's just maybe do the sum over here. It cost 5,400, but it's now only got a book value of 3,200. That means there's accumulated depreciation there of 2,200. Okay, so I'm going to take that out of the accumulated depreciation for equipment. Okay, so your accumulated depreciation is minus 3,000 in the assets. So to take 2,200 out of that, you're going to add it on. Okay, so there you can see the asset worth 3,200 euro being taken out of your assets. Okay, so now we're not balanced. Why aren't we balanced? Well, there was a debt there of 4,000 euro, and I've got that written off by giving them something worth 3,200 euro. Okay, so I've actually made a profit on the disposal of that asset. So by getting rid of something worth 3,200 euro, I've got a debt of 4,000 written off. So that's an 800 euro profit on disposal. So I'm going to add 800 euro to profit and loss. And there we see 3,200 been taken away from assets and 3,200 been taken away from liabilities as well. All right, so I will leave this part of the video here, and I'll just deal with the 2 December entries in the last part of the video.